We're going to keep it on markets and bring in our next guest. Matthew Miskin is co-chief investment strategist at John Hancock Investment. Matthew, thanks so much for joining us today. So, markets trading on hopes of de-escalation of tensions between Russia and Ukraine and a lot of rumor. What sort of conviction is there in the market right now?
Yeah, every moment the market is twisting and turning based on headlines, and we wouldn't overplay it either way. There's still a lot of uncertainty around this geopolitical risk, but we're looking at the earnings picture, still pretty good. Economic data is okay. But right now we're kind of stuck in this stagflation type environment where the economic data is kind of stagnating, and yet inflationary pressures are still building. PPI today came in hotter than expected. Empire Manufacturing came in about flat. And so we're kind of in this air pocket here where we're still stagflation type backdrop. We think growth does come back here in the next couple months. Earnings stay solid and equities up for a bit of an opportunity.
And then what do you think about inflation peaking anytime soon? Are we at the peak? Does it get worse before it gets better? And what are some of the prime causes of that inflation? How much of that can correct itself?
Yeah, we do think a lot of it is supply chain disruptions. I mean, you think about what is the one of the largest inflationary pressures, it's been used cars. And it's hard to say used cars, prices going up 40% is based on the Fed or based on, a lot of stimulus, but it's really to us that is a supply chain disruption issue. We do think that fades over the course of the year. That was the one bright spot in the CPI report, was that used car prices are starting to moderate. So that's a good thing. But yeah, otherwise we think that, by the end of the year, we're looking at 3 to 4% inflation off the 7% we're at right now. We think year over year, the comps are going to get higher into April. That's going to be a big step up in terms of the base effects. But at the end of the day, it's just been even month over month in January. You really want to see it decelerate a bit. It didn't, but these disruptions should ease as the pandemic comes down, which we think will happen here over the next couple months.
So Matthew, tomorrow we get more Fed speak, right? We hear about the minutes, and we already know Bullard is aggressive. He wants to tighten and much more comprehensively. So what do we learn that we don't already know? Because we know the Fed is behind the curve. They still are behind the curve because we know nothing about QT. We don't know how to unwind this $9 trillion that they have on the sheet. It's not been done before. And, we still know so little.
Yeah, I don't think it's going to be a huge change. And we do have a lot of speakers. So you're hearing real time their inputs, and things are changing fast. I mean, a Fed meeting, a month ago or even weeks ago seems like a lifetime ago, given how much the data has been changing, inflation data has been changing. So, I think Bullard is coming out and adding more and more volatility to the market, and that's not really helping the situation. The market is pricing in a lot of rate hikes this year. And I think what the market's really going to be keyed in on this week is, do we get 50 basis points at the March meeting? And that would be a pretty abrupt start to a Fed tightening cycle. We think that they do one, and it helps actually steepen the curve a bit and gives them more time to raise rates all in. But if they come in with 50 basis points, and if they stay very hawkish, the curve could invert, meaning 2-year yields could catch up to 10-year yields and really hit the same yield level. And that's not a good sign. And that could be happening here in the next couple months.
I want to ask you your assessment of tech stocks. They're much higher, while yields are also much higher. Usually they go in different directions. What do you make of that?
Yeah, I mean, today is seeing a bit of a reprieve in the technology space after some pretty tough performance. I think some of that's the M&A activity in the semiconductor space that you guys were just talking about, but the fundamentals still look strong. At the end of the day, the earnings are going to be the key driver of returns, and earnings estimates are good in tech. The street's looking for about 11% earnings growth this year, higher than the overall market. And one of the things we think is misunderstood about technology is they can raise prices too. They can, cause inflation, whether it's subscription rates, whether it's new products raising prices. They can pass on higher prices because they've got good moats. They've got good stances in their industries, competitive advantages, and that can cause higher prices and pricing power in technology as well.
So then, how do you reposition the portfolio? What do you tell people to do at this point to hedge against inflation and geopolitical risk? Or is it time to sort of park your money and sit it out for a little bit, wait and see?
We see a lot of things on sale right now. And in the bond market, for example, you're starting with higher yields. Yields have really elevated, but you're looking at 3-4% yield on some corporate bonds. That's a pretty attractive starting yield for longer term investors. And in the equity market, you've seen valuations become more attractive. So the PE ratio on the S&P 500 now about 19 times. Earnings estimates are going up while prices are coming down. So that's valuation. That's a better valuation entry point. So we're seeing actually better entry point in parts of the equity market, better entry point in parts of the bond market, and cash is still earning zero. So that's the worst place for a 7% inflation. We think a balanced portfolio offers a lot of opportunities starting today.
It is so interesting how bonds suddenly became much more attractive all of a sudden. Okay, we'll have to leave it there. Matthew Miskin, Co-Chief Investment Strategist at John Hancock Investment Management. Thanks for your tips today.